So, the energy infrastructure giant Enbridge just beat its earnings expectations, and you better believe analysts noticed. Today, we're going to deconstruct a fresh analyst report to really get a look behind the curtain of this North American energy powerhouse. Let's get right into it.
Okay, so right off the bat, the big headline from this report is a pretty significant bump in the company's valuation. The analyst has upped their fair value estimate for Enbridge stock to 66 Canadian dollars, all the way up from 62. In plain English, that just means they see more fundamental value and potential in the company than they did before.
So you gotta ask, right? What's giving analysts all this confidence? What are the core strengths that make them see such a bright future for a company of this scale? Well, that's what we're here to find out.
To really get inside the analyst's head, we have to start with the one key concept that their entire argument is built on, the economic moat.
So what in the world is an economic moat? Well, think of it literally, like a moat around a castle. It's a structural advantage that protects a company from would-be competitors, letting it rake in profits year after year, reliably. It's really what separates a decent business from a truly great one.
Now, in Enbridge's case, the analyst gives it a narrow moat rating. Now, that doesn't mean the moat is weak at all. It means the company has some very real, very durable advantages, but they aren't completely impossible to overcome. Think of it as a really strong fortress, but maybe not an invincible one.
And what's really interesting is where that moat actually comes from. You can see here that a full 50% of the company's earnings come from its massive liquids pipelines. Gas transmission and distribution make up most of the other half, with just a tiny slice coming from renewables. So the overall strength of this company really boils down to the strength of these individual parts. So the analyst sees this entire fortress as being held up by four main pillars. Three of them, the liquids pipelines, gas transmission, and gas distribution, are each considered strong enough to earn their own narrow moat rating. But that much smaller renewable energy business, well, it just doesn't have that same competitive edge. At least, not yet.
The absolute crown jewel of this kingdom is the mainline pipeline. This single system is just unbelievably critical to the North American energy grid. It moves about 3/4 of all Canadian crude oil exports. It is so huge and so entrenched that building a competitor would be practically impossible. Now that is a moat.
And it's not just oil, right? The gas business is just as strategic. Just listen to this quote from the report. Enbridge's pipelines aren't just anywhere. They are plugged directly into the vast majority of all known future gas supplies in both the US and Canada. Talk about being in the right place at the right time. Okay, so that's the picture today. We get where the company's strength comes from, but what about tomorrow? The report also spends a lot of time on that. So where exactly is Enbridge placing its big bets for future growth? Well, according to the analysts, the answer could not be clearer. Yeah, the liquids business is the cash cow for now, but the company is pouring most of its new investment money into natural gas. They see a long runway for growth in gas transmission all across North America.
And hey, this isn't just talk. This strategy is already playing out. The company has this really clear multi-year roadmap of major projects coming down the pike. You've got expansions set to come online every single year for the next few years, from the US all the way to the Canadian West Coast. This just doubles down on their bet on natural gas and even expands the powerhouse mainline system.
But of course, there are always two sides to every story, right? No investment is a sure thing. And the analyst report does a fantastic job of laying out the two competing views for Enbridge's future. You've got the optimistic bull case, and then you've got the pessimistic bear case. So let's break it down. The bulls, they're looking at that irreplaceable mainline pipeline. They're pointing to the growing demand for natural gas, and they love the steady, predictable money that comes from the utility side of the business. But the bears, they're watching for new pipeline competition. They're worried about how Canada's carbon tax could affect things, and they're keeping a close eye on the rising cost of all the company's debt.
So this brings us to the really important question, right? From the bears' point of view, what are the actual threats? What are the catapults and the siege towers that could actually try and breach that economic moat?
The report really zeroes in on four big risks. First up, regulators. They get the final say on the fees Enbridge can charge and whether new projects can even get built. Then there's the debt. The company is carrying a lot of it. Third, those Canadian carbon taxes could eventually start to eat into the profitability of oil production. And finally, you have geopolitics. Things like trade tensions or a sudden flood of new oil in the market could change the entire game overnight. All right, so we've looked at the strengths, we've seen the growth plans, and we know the risks. So how does the analyst take all of these pieces, put them together, and land on that $66 fair value estimate?
This chart here gives you some really great context. See, the orange areas show you when the stock was trading above what the analyst thought it was worth, and the blue shows when it was trading below. For years, the stock price and the fair value estimate have kind of danced around each other, in this constant cycle of being seen as over or undervalued by the market. So that brings us to today. This simple little thermometer shows that the stock's last closing price was around $73, while the analyst's fair value is $66. Basically, in their view, the stock is currently trading a bit ahead of its fundamental worth. The analyst calls this fairly valued, which is just a way of saying it's probably not a huge bargain at the current price. And this table here, it really pulls it all together. It's a company with a solid narrow moat, but there's medium uncertainty, which reflects all those risks we just talked about. And its capital allocation is rated standard, which is good, but it's held back a bit by that high debt load. So in short, a strong company, but definitely not a perfect one.
And that brings us full circle. The analyst sees this powerful fortress with a narrow but pretty effective moat, all protected by assets that are critical and incredibly hard to copy. But at the same time, it's facing some very real threats, from regulation, from debt, and from the shifting winds of the market. So the ultimate question this report leaves us with is whether that whole foundation is built on solid rock or on shifting sand.